Welcome back to the show. Welcome, welcome. You're watching Namdi, and we've been talking about trading options and trading crypto. And I'm on a journey to master that scale. Who's coming on with me? Who's coming along with me? I hope you are ready to learn and follow along. Okay, so the last time in the last video, we discussed measured moves. We discussed seeing chart patterns using technical analysis. And a lot of it involved different measured moves, different patterns. And we went over it. But in this video, we're moving on. We're moving on to the next chapter. And in this time around, we're going to be talking about how to draw trend lines. And we'll discuss getting to know the price chart, figuring out trends, knowing about rule-based trend lines, acquainting yourself with internal trend lines. Very often you're going to see a trend. Sometimes when you look at a chart, it can be hard to spot a trend, or sometimes it can be really easy depending on how the market is doing. Usually you might not even need to draw any trend lines or make any drawings to determine what trend the market is doing. But sometimes it's necessary to sort of connect the dots by actually drawing a line along the price bars. And what does a trend line do? A trend line is a straight line that it starts at the beginning of the trend and stops at the end of the trend. You can do this by using one of the tools, a trend line. You just pick it up and you try to connect or touch as many candlesticks as possible. What you're trying to establish is a support for the price action, and it'll give you an idea where well, actually not a support, but a trend line. You just want to determine whether we're in an uptrend or in a downtrend, if the market is bullish or bearish. Sometimes the trend line pops out just by looking at the chart. The price is moving in a consistent fashion, either up or down. Usually just by looking at it, even without the need of a trend line, it's easier to spot, but sometimes it can be frustrating depending on how some of these charts can be really ugly, especially if there's high volatility. It's hard to determine what direction that chart's going. And that's where you need a trend line. When you look closely at a chart, you can feel a higher level of confidence that your trade is the right one when prices are following your trend line. And this other point that makes it important to determine the trend of your chart is that a break of a trend line is a high probability indication that the trend has ended and you need to either exit your trade or just take an action for your trade. Now, I would like to highlight that there's no way to predict when a trend's going to stop. There's no magic wand or any indicator or any tool that's going to tell you when a trend is coming to an end. So a trend line is a work in progress that needs constant reevaluation, which basically means that you're going to need to check the price after the close to see where it stands in relation to your trend line. This explains why a lot of traders stare at the charts a lot. It's just because you have to keep reevaluating what the trend in the market looks like, depending on whether you're swinging or you're scalping a trade, how long that your trade is going to last. So it's also sometimes um, it can be hard to judge the day's outcome, even with a rough hand-drawn trend line. What people will do, or what some traders will do, is you can extend a trend line artificially out into the future in the hope that new prices will respect that trend line. But it's important to note that the extended line is only a hope and expectation. It's not actually real because we can't predict the future, and the trend line does not predict the future of price action. You can, extend the line out with the hopes that it's going to continue a bullish movement and price action will reverse on you. Also remember that the time frame of the chart you're looking at influences what you see. If you're looking at a longer time frame, you may see one trend on a weekly chart, but if you're a swing trader with a shorter time frame, you're going to see multiple trends on the same chart. In order to see the single long-term trend line, you're going to have to accept that charting is a dynamic process. Like I mentioned earlier, you're going to be reevaluating your trend and redrawing those lines throughout the day or throughout your trading time frame. The work is never done. Just keep an open mind and be willing to discard whatever drawings you've made, whatever charting you've done. Be willing to discard the trend line. Don't get emotionally caught with or tied to whatever idea you have or prediction you may have based on your technical analysis. Your work is never done. You may have to discard the trend line. You may need to restore an old trend line with some minor modifications. If your original drawing turns out to be right, then it's okay to go with that. Also keep in mind that the move is a big picture. If the move in the bigger picture is an uptrend, it's possible that you might not know how long it's gonna last. But you can't predict how long that trend's gonna last. Also, another thing to note is that on certain occasions, you can draw one trend line only to realize later that you can draw a better one when you look closer on the chart. Some trends are orderly, making it easy to spot them, while other trends are disorderly and difficult to determine. Here are the rules. Just know that you're always welcome to draw any old line that you can spot on the chart. But rule-based lines have a long history of actually working to improve trading results. And the reason is because everyone knows the rules and they draw the same lines. The market is a psychological thing, and if most people participate in the market, if they're following the rules, they all behave the same way, and price in most cases respect their psychology or respect the trend line, those rules. So rule-based lines have a long history of actually working to improve trading results, in part because everyone knows the rules and they draw the same lines. It's going to give some practical meaning to the phrase reading the mind of the market. A rule-based trend line is one that starts and stops according to well-defined conditions. An example is a line that starts at the lowest low of the last 3 days and ends at the highest high of the last 3 days. That's a rule. And if you stick with that rule, you're more likely to get the same results. A rule-based trend line is better than and one that's based on impression or conjecture. Um, and these are for three specific reasons. One, it doesn't let you impose your personal view of what the trend should be. Two, it improves your ability and self-confidence to buy the underlying security when its price is rising or sell it when it's falling. Three, it helps prevent loss by showing you the exit at the right time. Let me go over that again. The reason why most traders use rule-based trend line is that um, it starts and stops according to well-defined conditions, such as a line starting at the lowest low of the last 3 days and ending at the highest high of the last 3 days. A rule-based trend line is better than one that's based on impression or impressions. And like I said, it's because of three specific reasons. It's going to help you to prevent loss by, and you're going to know when to exit the trade at the right time. Second, it's going to improve your self-confidence and your ability to buy the right security when its price is rising and sell it when it's falling. And finally, it doesn't let you impose your own personal view of what the trend should be. You're going specifically by the rules. So how do you draw rule-based trend lines? Let's go right into it. Remember that when you're drawing a rule-based trend line for an uptrend, you start at the lowest low and you connect the line to the next low that precedes a new high. Two, as long as new highs are being made, redraw the line to connect to the lowest low before the last high. And three, when prices stop making new highs, stop drawing. Extend the line out into the future at the same slope. That's for drawing. Those are the rules for drawing an uptrend. The rules for drawing a downtrend are: one, start at the highest high and connect the line to the next high that precedes a new low. Two, as long as new lows are being made, redraw the line to connect to the highest high before the last low. Three, when prices stop making new lows, stop drawing. Extend the line out into the future of the same slope. Now, just based on these rules, you can already tell that this is a dynamic process. You often have to erase one line and draw another one as conditions change. Now we're going to talk about how to use a support line to enter and exit a trade. A support line is named support because you expect that line to support the price action. Traders won't let the price fall below that line. You start at the lowest low and you draw the line to the next low. It generates a line that can be extended at the same slope, but it becomes a trend line only when another daily price low touches the line and bounces off of it. This touch bounce is confirmation that the line is more than just a line, and it is a true trend line. When you use the support trend line as a trading guide, you initiate a new position on the confirmation right after the third touch. Some technical traders say that to require a third touch is to be overly cautious and to miss out on some perfectly good trends that fail to meet the third touch qualification. And this, in a lot of cases, is true because many valid trends do have only two touches before they end. If you're waiting for the third touch, you may miss the entire move. You may even say that two touches is better than three or more because that means that particular security does not have a crew of, really smart buyers that are testing the support. But most experienced traders know that your trust is better placed in a trend line with three or more touches. You're taking more risk if you only accept two touches. So when you're drawing a trend line, it's safer to make sure it has three touches. All right, Moving right along, one thing to remember is that the support line entry rule is buy on the third touch of the support line, buy the low of a price bar. On the other side, the support line exit rule says sell when the low of the price bar falls below the support line. In certain trades, um, traders like to push the price to the break, push the price to break the support line, but then buy it back so that the close remains over the support line. Um, the important thing is that you need to watch your security to see whether it's the low breaking the line that matters or if it must be the close. So what's important to you? Some people like to push, some traders will prefer to push the price to break the support line and then wait to buy it back so that the close of that candle remains above the support line. But you're going to need to determine what's important to you when you're drawing these your trend lines or your support lines. You by doing what you need to do is to watch the securities to see whether it's the low breaking the line that matters or if it must be the close. You're going to use the support line to identify an uptrend. The price is rising and rising consistently. uh, Essentially, if you can get a support line uh, that's if your price action is respecting your support line and it's rising, and rising consistently to confirm an uptrend, it's going to give you comfort and confidence that the purchase of that security is returning a profit and may continue to return a profit for as long as that uptrend lasts. Another tip is to know that the more times that the low of the day touches the support line without crossing it, the more confidence you're going to have to validate the trend. This is basically called testing the support line, test of support. It gives buyers confidence that the security to keep buying to buy the security because it respects the support line. So they're gonna basically buy more um, of the securities after the price passes the test. You're gonna notice that fresh buying of securities constitutes demand for the security and it's called accumulation. People who already own the security are reluctant to sell it after support has passed the test and now require a higher price to put their inventory for sale. Remember, this is important. Sometimes traders engineer a test of support by selling the security down to the support line to see whether support will hold. If you put on a new long position above that support line, um, it's going to be hard to test that support because it's not very clear a lot of times whether buyers of the security will rush in to buy more of that security to defend their positions. When the support line does hold, when price action tests the support line and it respects it, most traders who are selling will immediately become buyers, and you're going to see a rush of volume to pick up more of the security because that is a sure proof that the bulls are in full force. Basically, if you bought the security and you survived the test of support, you're more likely to get uh, a sizable profit in that move. When any part of the price bar penetrates the line on the downside, support has been broken, and you may deduce that the trend is over. However, this trend um, and that trend end may not be actually realistic. It might be a false uh, or what they call what's that word? A fake out. A break of support is just what it means. It means that some holders of the stock are willing to break ranks with the other holders and to sell at progressively lower prices. There's always those people in the market that is gonna, it's like a race to the bottom. They're gonna try to keep testing the support and even break the support line and try to sell at lower price. A breakout is any part of the price bar penetrating um, a line that you drew on the chart, whether it's a resistance line or a support line. The bar component that breaks the line has to be the close. A breakout is used in different ways. It could be, but for the most part, it always refers to a significant violation of the trend. Sometimes offending breakout is quickly reversed, but usually a breakout means that the trend has changed or reversed its nature. And usually that is an impending change in direction. In some cases though, a downside breakout of support that is immediately followed by a series of higher highs indicates that bulls got a second wind and are violently repudiating the breakout. A continuation move after a downside breakout tends to be uncommon, so I wouldn't count on it. All right, so moving right along, um, we're talking about breakouts. It's any part of the price bar that penetrates a trend line or support line or resistance line. Any line that you drew on the chart, when the price action breaks or penetrates that line, that's defined as a breakout. People use that word interchangeably in technical analysis, but it always refers to a significant violation of the trend. Sometimes the offending breakout is quickly reversed. Wow, it's like just went off of me. Yeah, sorry about that, guys. I'm playing with the light over here. There's motion sensor lights that you can't control. Very annoying. All right, moving right along. I was just talking about breakouts. And sometimes the offending breakout is quickly turned around, but usually a breakout means that the trend has changed. And usually it signifies an impending change in direction. In some cases though, a downside breakout of support that is immediately followed by a series of higher highs indicate that bulls got a second win and are violently repudiating the breakout. A continuation move after a downside breakout, a continuation move after a downside breakout tends to be uncommon. So I wouldn't count on it. Sometimes the low extends beyond the support line for just one day, and then prices obediently fall back into line. Subsequent prices respect the support function of the line. A one-day break of the line is called a false breakout. The word false is misleading because the price really does break the line. What's false is the conclusion that you draw from it. To estimate whether a breakout might be false, um, it's recommended that you consider the position of the close on the day before the breakout. In an uptrend, if the close is at or near the high, chances are that it is a false breakout. The breakout was due to a profit taking that got carried away. It was triggered by a false rumor, or it may have been a random move. If the close on the day before is at or near the low, chances are the breakout is real. I would recommend that you discard the support line as a trading tool after it has been broken. Um, but you may want to leave it on the chart for a while because sometimes old support becomes new resistance and vice versa. The other side of On the other side though, we're going to talk about using the resistance to enter and exit a trade. We just talked about using the support line. And I can go over some of that stuff again. But let's talk about using the resistance. First of all, what is a resistance? Resistance is the mirror image of the support line. A line drawn along a series of highs marks where buyers resist buying anymore. The price is too high for them. Traders expect sellers to emerge at the resistance line and take profit. You may be wondering why you should care about resistance lines if all you're ever going to do is buy the securities. But as a buyer, the only trend line you care about is the support line. But you should care about identifying a downtrend using the resistance line for two specific reasons. One, when a downtrend ends, the next move may be an uptrend. And two, you may at some point decide to sell a security or short sell a security. In the first instance, when a downtrend ends, it suggests that the price is about to reverse to an uptrend. So you want to get in on the action as early as possible. You care about so you care when a downtrend is broken to the upside. The breakout is an important clue that an uptrend may be starting and you should start paying attention. If you do decide to short sell, it's really a difficult thing for newbies to do. But if you do decide to short sell, which is only a mirror image of longing or buying or being bullish, you're just inverting the chart and you're selling instead of buying. Anyway, if you do decide to short sell, if you've been trading exclusively on the stock market, chances are you're not familiar with initiating a short position or selling a security first and buying it back later after its price has fallen. So that's essentially what short selling is. Short selling is the act of selling a security first and then buying it back later after its price has fallen. Commodity traders, on the other hand, are familiar with the practice because after all, we're striving to be emotionally neutral here about whether prices are rising or falling. So it shouldn't matter whether you're profiting in an uptrend or in a downtrend. To make a profit, only when a price is rising is to lose 50% of the opportunity presented by the trend. So I would advise to keep an open mind because the chart doesn't care about your emotions. It doesn't care about who you are or what you care about, what your beliefs or ideology are. If your goal is to profit from the market, you should keep an open mind and learn how to profit from the uptrend as well as on the downtrend. Moving right along, experienced traders will probably see the new line as an opportunity to increase a short position. Along someone who is buying or long only trader will be watching the second resistance line for the opportunity to buy the security with a holding period that lasts only until the price nears the topmost resistance line. That topmost resistance line is where, again, that's where most sellers are hanging out at. So, and people are taking profit over there. So they're going to meet resistance. Note that selling the security on the third touch of resistance and covering the short position when the price breaks the second resistance line would have given you a return of about 20%. Sorry, that's specifically for a particular chart that's on here, but what we're trying to get out of it is how resistance line works in relation to the price action and the trend of the market. When to exit to trade or when to buy more. We're talking about the resistance line here. We earlier on discussed the support line in resistance to price action, and we're currently discussing the resistance line. The logic for trading using resistance line is the same as the support line. but in reverse. The more times the high of the day touches the resistance line and doesn't cross it, the more confidence that you have that it is a valid description of the trend. This is called a test of resistance, and it encourages sellers of the security to sell more after the price passes that test. First selling constitutes supply of the security and is called distribution. Those who own the security are reluctant to hold it after resistance was proved to resist an effort to break above it. They are willing to sell their inventory at increasingly lower prices. So in a market, there's buyers and sellers. There's a security, an underlying security that's being traded here. The market determines what the price for that particular security is at any given time. And to determine what that price is, we use the resistance line to determine it. The demand zone, or the area, or the price action revolves around that resistance line. That's the price that people are willing to pay for it. And if you notice that price action keeps meeting that resistance line and respecting it, there's going to be a period where people who own that security are people who hold that security are going to try to sell off that security at that price. That period is called a distribution. And most people are willing to sell at that particular time. So, and most times they sell even lower than that price, because until price penetrates that line, there's a high chance of price breaking to the downside. And if you're holding that security, you don't want to risk losing a chance of maximizing your profit on it. So you get rid of it. Remember, to trade using support and resistance line exemplifies the ruling principle of trend following trading. You never enter at the absolute high and you never exit at the absolute low, because we don't know, or we can't predict what the absolute high or the absolute low is. We use our support and resistance line to guesstimate or to have an idea what's the right price to buy and what's the right price to sell to maximize our profit. The goal is to capture a portion of the trend. Most traders are willing to let others have the first third of a move and the last third of a move. Most traders want the middle portion, the beefy portion, that part that's very safe, and you just you set your take profit positions and your stop loss and be done with it. So how do you fine tune your support and resistance? You need patience, lots of it, patience and persistence to work with the trend lines, because you need to adjust the lines often, sometimes daily. You're going to hardly ever be lucky enough to get a clear uptrend along the support line and then a breakout of the support line that turns into a downtrend with a tidy resistance line. That rarely happens. Instead, the price will wander around and perhaps test the last high, which can be very annoying if you sold at the break of support. So price does this thing where it moves up and down and distributes a little bit. It can be annoying if you sold at the break of support, which is like, so it takes a lot of patience and persistence. Now, let me give you a quick tip. Congestion and consolidation describes the same thing. Trendless prices trade in a range. So if the price is not, if there's no confirmed trend on your price action, whether upside or downtrend, it trades in a range. That's what we call a consolidation or congestion. Often that range is defined by a previous high or low. Consolidations often precede and follow a breakout. If you see a period of sideways price action and can't find a trend, it's recommended that you widen your chart to include more data and switch to a longer time frame, like move to a weekly or monthly chart. Chances are you're better to you have a better chance of uh, getting a nice picture or get a better view of what price action looks like. And you're probably going to get or have, there's a chance that you may have just gotten a breakout. Remember, a breakout is when price action penetrates your line, whether it's a support line or a resistance line. That's what you call a breakout. What you don't want to do is uh, to focus all your attention on the support and resistance line. What you need to focus on is the trend itself. Once you've identified the trend, the job of the support and resistance line, just don't focus so much on it, because people make decisions about buying and selling because of what happens to their support or resistance line without anything real actually happening within the underlying trend. Support and resistance lines occurs a lot on charts, and nowadays so many people are aware of them that to some extent they become self-fulfilling prophecies. A large number of people draw and respect the same support and resistance lines. Some people want to defend the price because they own the security and want to see it survive a test of support so that more buyers are encouraged and it can rise some more. Other traders want the price to fall so they can buy more of the security for a cheap price or to cover a short position. In some um, in some cases, though, the traders in the market know where these small or retail players have placed their buy or sell orders, because as amateurs, they select the obvious support or resistance lines. So professionals will go out there and just like stop them out or just fake them out. So what they do is professionals, they can pick off the amateurs for a quick buck. What they will do is they'll push the price under a support line just to spook amateurs into selling. You end up going through a tricky and complicated train of thought whereby you don't place your order at an obvious level, because that's exactly where the big guys, the big big bank, that's exactly where they expect you to place your trades, or to place your levels, and then you miss an entry or exit at the best price. Um, it's important to remember that drawing good and valid trend lines is not enough. That's just part of it. What you want to do is study how the crowd that trades your specific security, how they behave at resistance levels or at breaks of support, because it'll give you an idea how the price action behaves. It's not the line that counts, it's the crowd psychology that created the line. Moving right along, we're going to talk now about drawing internal trend lines. So one thing to know that I've touched on already is that there's no perfect trend line. We can't, trend lines are not 100% proof. They don't guarantee anything. But one thing to know is that there is such a line that would reveal the hidden trend of the price without at the same time setting off an alert to other traders. That line is an internal trend line. It's a line that goes through the center of the price series rather than along its edge, like support and resistance lines. Support and resistance line operate at the edge of the price action, at the edge of the candles. But there's what we call, there are lines that go through the center of the price. and to follow the rules with rule-based trends or trend lines. So how do you draw a straight line through the center of each price bar? Technically, you can't, at least not on any chart where the prices jump around at all. It's difficult to do that. But what expert traders have figured out how to do is to fit a line that minimizes the distance from itself to each price, and it closes along the line. The best fit line. That's what we call it. The best fit line is named the linear regression line. Linear referring to line and regression referring to the mathematical calculation. You don't need to know how the line is calculated to be able to use it. You probably can't explain an auto transmission either, but you still drive a car. So all you need to know is that the linear regression line is the best fit line that goes through the price candlestick. Just know that you can't draw an accurate linear regression without first performing a complex statistical calculation. Spreadsheet software and all charting packages come with the linear regression already built in it. Don't try to figure it out. Just easily, just use it. It already comes along with some of these software. Anyway, here are the rules for drawing a linear regression line. Figuring out where to start and where to end a linear regression line is the first big obstacle in using one in a practical way to help you make trading decisions. The simple answer here is to start it at an obvious high or low, meaning that you need to look backward at the historical data on the chart to see where the current move began. This historic data can get very different slopes depending on how tightly you want the data to fit the line. Seeing a welter of slopes covering up your chart can get very frustrating, but stick with it. What you would need to do is to pare back the surplus lines until you get one that looks best to your eye. So you're just drawing a line through it that kind of touches most of the candles and gives you an idea of what that trend is. So where do you end the linear regression? This takes some practice with other indicators such as a gap, a giant outside day, a moving average crossover, a change in momentum, or even a non-technical development. But like I say, a linear regression line will usually start at an obvious high or low and end basically just you started at an obvious high or low and you draw it to try to include as many candles as possible, going through and touching as many candles as possible in a zoomed out chart. That's how you draw a linear regression line. You may see charts by self-appointed gurus and a lot of people on YouTube that show a linear regression and advise that prices are mean reverting and exhibit a central tendency, meaning that a big variation away from the linear regression line will automatically correct back to the linear regression. That's not true because in reality, there's no reputable trading system that features the linear regression as a trading tool. What to keep in mind when you're drawing a linear regression line is that the linear regression line doesn't actually go through the center of each price bar. In fact, some price bars are quite far away from the line, but if you look more closely, After you draw one, you can see that no other line gets you as close to point A and point B at the same time. Only one linear regression exists for any set of prices on the chart. Regardless of how fancy the name linear regression may sound, if you have basically, if you get the right line, it's only one, and it can't, there's no duplicate of it. Most people who try to draw a linear regression line are probably going to get the same line, type of line, if they do it the right way. It's a true, pure trend line. If you accept the core concept of technical analysis, that a trend will continue in the same direction, at least for a while, then you can extend the true trend line and obtain a forecast. Some software or some people call it a time series forecast because it's really useful. You've created a high probability forecast for the upcoming time frame that gives you perspective on what to expect. Here's the downside of a true trend line or a linear regression line is that the linear regression line can slope this way or the other way or no way at all, meaning like it's horizontal, depending on where you start and stop drawing. If you take a V-shaped price series and draw a single linear regression line, you're not going to get an accurate line unless you have a very a very long holding period in mind. This chart, what you find out is that um, the less daylight between the line and the price points on the chart, the better the fit, and the more likely it is that that extending the line is a valid technique. Now, also keep in mind that even if you draw a linear regression line and it doesn't look like crap in relation to the price action, and it looks like doesn't make any sense, it can still be valid because everyone else is probably going to get the same result. But just keep in mind that most traders won't advance the cause of making a profit in the market or prevent a loss with that. So how do you use a linear regression line? The linear regression line does not take the place of support and resistance lines. What it does is it should be viewed as a supplement or confirming indicator to identify the trend. First, you identify the trend, then you draw your support and resistance line. So linear regression line comes first in that order. So if you select a good starting point, the linear regression delivers pure trend. Unlike support and resistance lines, the linear regression line doesn't have any trading rules associated directly with it, but visually, the linear regression line is the most informative. If you draw a support or resistance line whose slope varies dramatically from your linear regression line, one of them is wrong. In a similar vein, if the line has a very steep slope and no other linear regression line on the chart of the same security has such a steep slope, you can deduce that the price movement is statistically abnormal. It is unsustainably fast and likely to move or to come to a sad end when traders start taking profit. Okay, so here are 2 points, 2 things to note when you're drawing a linear regression line. One, when you suspect that the price is accelerating, it doesn't matter which direction. At an abnormally high speed, first you draw a true linear regression line from the beginning of the data series, and you stop it at the point where it's abnormal, the bubble, when the bubble begins. Two, extend the line and by cutting off the bubble or cutting off the abnormality. The extension of the trend line becomes a more realistic forecast because we know that bubbles always burst. So anyone drawing a linear regression trend line extension understands basically that it's a subjective process and it doesn't always work, but it gets you thinking about the overall trend of the underlying security. Just so you know, it's really easy to do something stupid when using linear regression line. For example, a linear regression line that is very far away from some of the prices on the chart is probably not valid. Also, if you extend the line out into indefinite, if you extend the line out indefinitely, it's not a forecast, it's just wishful thinking. The market is a collection of human beings. It's a collection of psychology, it's crowd psychology, and prices simply don't move in a straight line indefinitely. The linear regression line, it can work if you can get a best fit. All right, people, I think I did that justice. You can rewatch this video to get an idea if you missed anything. Thank you for watching. I'm gonna continue this series because I'm also learning. I'm gonna read it again and get an idea. If you want to rewatch this video, you can rewatch it because yeah, I'm reading, but I'm also going to reread because that's how I learn. And so feel free to rewatch this video, and I'll see you next time.